What's up, you guys? It's Graham here. So I'm going to be honest, this is one of the craziest markets that I've ever witnessed. Normally, I tend not to be too outspoken about my own thoughts since I'd like to think the data speaks for itself, but never have I seen such an intense back and forth of economic turmoil while the entire market crashes within minutes of a single remark. And if you thought things were getting messy, as it turns out, this is just the very beginning. In just the last week, we've seen tariff retaliation, stock indexes falling into correction territory, concerns of an upcoming recession, and most recently, as of a few hours ago, we've received some choice words from the Federal Reserve as to what they think is going to happen over the next year, which is probably not what you're expecting. This is why we absolutely have to cover exactly what's happening, what Jerome Powell just said, when they're planning to lower interest rates, and then most importantly, how this is about to affect all things money. Because without exaggeration, this is one of the most important meetings of the entire year, and if you want to come out ahead profitable, keep watching. Although before we start, if you appreciate the last minute breaking news videos, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. I know it sounds silly to ask, but it actually does help out tremendously, and as a thank you for doing that, I'll do my best to read and reply to as many comments as I can. So thanks so much, and also big thank you to Cook Unity for sponsoring this video, but more on that later. Alright, so in terms of where to start, let's just get the main point out of the way first. Tariffs. Without exaggeration, this has become the single most influential topic for not only the entire economy, but also the entire world. And it's also a topic that seemingly changes by the hour. Like, here's the thing. I could sit here planning out a very detailed video, and by the time I get ready to post it, the entire situation has changed. So when it comes to this topic, here's all I'm going to say. Overall, most economists agree that tariffs are harmful to the economy, to the stock market, and to consumer confidence. Generally, when volatility increases, people spend less, companies scale back, stock prices fall, and videos with flames in the thumbnail get 3 times more views. But in terms of Trump's strategy, he openly believes that short-term pain is the only path to long-term prosperity. In fact, he recently did an interview warning that consumers should prepare for some short-term turbulence. And if you haven't seen that video yet, here you go.
Are you expecting a recession this year?
I hate to predict things like that. There is a period of transition because what we're doing is very big. You can't really watch the stock market. If you look at China, they have a 100-year perspective. We have a quarter.
Basically, whether you agree or disagree with his methods, it seems as though he's using tariffs as a strong negotiation tactic, knowing that it's going to put more pressure on the other country than it will on the United States. Obviously, this is a high-risk strategy, and if other nations refuse to back down, it could spiral into some rather volatile, severe long-term consequences. But considering how this has played out so far, it's worked, and this seems to be exactly what's going to happen. Trump threatens tariffs to start in 30 days. Other country says they'll retaliate. The market drops. 30 days later, Trump either gives a temporary extension, in which case the market goes up, or Trump follows through with his tariffs and the market goes down. Other country then retaliates with their own tariffs, so Trump doubles his tariffs as a punishment, market goes down even more, but 24 to 48 hours later, a temporary agreement is reached and the market goes back up again. There you go. I've just predicted the next year. You can't even make this stuff up. Like, if I give you any more details than that, the video is going to be outdated in a day and people comment, "This aged like milk." But again, regardless of what you think of this strategy, the market has not reacted very kindly, which brings me to my second point, recession fears. Here's the thing. Anytime there's economic uncertainty, companies delay hiring. They reduce their spending, unemployment begins to rise, and that lack of spending shows up as a decline in GDP, of which results in a recession after 2 consecutive quarters. Now, even though this might seem unlikely, when you look at the estimates, you'll begin to see that there's a solid chance that a recession officially starts this year. For instance, the Atlanta Federal Reserve estimated that first quarter GDP may decline by an annualized adjusted rate of 2.4%, which would be the first contraction since 2022. On top of that, JP Morgan put their current recession odds at 40%, owing to extreme US policies. Now, of course, the counter-argument to this is that job growth is still strong. Stocks are still up from where they were a year ago, and abnormally cold weather could be partially responsible for a lack of consumer spending. Although the good news is that if prices do begin to drop, they might soon begin to cut interest rates. And if that happens, you could potentially start making a lot of money, especially when it comes to the stock market. Look, it's no surprise, Trump has been a huge proponent of lowering interest rates. He's publicly pressured Jerome Powell to cut rates since 2019, and most recently, he's called to bring them back down once again. Why? Well, besides being able to refinance the national debt at lower interest rates, there is a direct correlation between cheap money and increased household wealth. So in terms of what you could expect, here's where things get really interesting. A recent study broke down investors into two categories. One considered the choice between a risk-free investment earning 5% and a risky investment earning 10%, while the second group made the choice between a risk-free 1% return or a risky 6% return. Now, in both cases, that risky investment pays the exact same 5% more, but the results were vastly different. It was found that low risk-free returns caused significantly more risk-taking for higher-yielding investments, even though technically the difference in payout was the exact same. Or I guess for all of you visual learners out there, when interest rates are at 0%, 70% of their portfolio went into risky investments. But when interest rates were at 5%, only 50% of investors took the risky category, which reflects a more balanced portfolio. All of this suggests that when interest rates are at record lows, investors throw their money into risky investments to earn as much money as possible to make up for it. And when interest rates begin to rise, they pull their money out of the markets to take the risk-free return, causing stock prices to begin to fall. This is why it's theorized that when interest rates eventually fall back down, investors are going to take their money out from the sidelines and throw it back into the economy, into the stock market, causing the prices to begin to recover. Although in terms of what Jerome Powell just said about this and what this means for you, here's what you came for. Although before we go into that, when it comes to making these breaking news style videos, I'm going to be honest. Usually it involves me clearing out the entire day, getting straight to work, and not taking a single break until I hit upload. Now, even though I certainly have a lot of fun doing this, it can be a challenge to make sure I get to eat throughout the day. Like, obviously, I don't have time to go in the car, go to the grocery store, pick up any food, which is why I'm so happy that Cook Unity decided to sponsor today's video. For those unaware, they offer restaurant-quality, pre-packaged meals that get shipped on a regular basis right to your front door for an amazing price, and they taste absolutely delicious. No joke, this food tastes like it's cooked fresh right from a restaurant, and when I broke down the cost per meal, it was cheaper than what I was spending at Chipotle, and without having to spend the time standing in line or driving. Ever since then, I've genuinely been a huge fan of their food. I eat them on a regular basis, especially on days like today when I'm on a deadline, and they have hundreds of options to pick from, each prepared by award-winning chefs with extremely high-quality ingredients. It's all delivered fully cooked, they're ready in a few minutes, so all you have to do is heat them up, and if you're trying to eat lean like me, they have plenty of options that are all under 600 calories. I also like how easy it is to start, stop, or pause service at any time. So if I know I'm going to be out of town for a week or so, I could log on, tell them I don't want meals delivered during those weeks, and it's done in a few seconds. And if you want some recommendations, I personally loved the curried grilled chicken with spiced cauliflower by Chef Dustin Taylor, Sri Lankan lobster curry by Chef Artie Sampat, and adobo grilled salmon by Chef Jose Garces. So if you're interested in checking them out, use the link down below in the description or go to cookunity.com/Graham and use the code GRAHAM50 at checkout for 50% off of your first order. Without exaggeration, at 50% off, it's an incredible deal and it's probably way cheaper than the meals you're already eating. I even turn these into mini date nights sometimes. So if you're interested, the link is down below. Enjoy. Thank you so much, and now let's get back to the video. Alright, so in terms of the Federal Reserve's recent decision to delay interest rate cuts, all of it comes down to one thing: inflation. That's because when we really get down to it, the Federal Reserve is only keeping interest rates higher for longer as a way to prevent consumer prices from rising more than 2% a year. And in terms of the most recent reading, it came in at, wait for it, 2.8% from a year ago, meaning it's trending downwards, but not as much as they want. Now, in terms of why prices are still above 2%, the largest increase, believe it or not, came from eggs, which were up almost 60% from a year ago. In fact, food away from home, like restaurants and full-service meals, were up 3.7% in the last year. And once you begin to zoom out, you could see that other items like car insurance increased by 11.1%, car repairs went up by 7.9%, apparel is up by 7.5%, and shelter is up by 4.5%, which is actually the lowest increase since December 2021. On top of that, if we remove food and energy from the equation, since those could often be at the whims of seasonality, core CPI fell from 3.3% in January to 3.1% in February, signaling a slight move downwards. Now, even though this can be seen as good news, none of this reflects any potential complications with tariffs, and there is the concern that inflation could soon start to go back up again if people pay an extra cost on everyday items. Like, if you want any specifics on this, the Boston Federal Reserve went on record to say that the new tariffs could add a minimum of 0.5 percentage point to core PCE inflation, and the earlier tariffs could have added a maximum of 2.2 percentage points, keeping all else in the economy constant. That's why when it comes to the Federal Reserve meeting today, here's what they had to say. As of a few hours ago, they've decided not to lower interest rates and instead take a wait-and-see approach until more data gets released. After all, they still have concerns about inflation rising from tariffs. They're worried that they might have to pivot if unemployment begins to rise. And by giving it a little more time and waiting for the next 2 months, they're going to be that much more confident when they make a more permanent decision. On top of that, Jerome Powell did speak about the possibility of future rate cuts later this year. And even though he didn't say exactly when it's going to happen, we could end up seeing a 25 basis point rate cut over the summer and perhaps another by winter, depending on if prices continue on their downward trend. And if not, we're probably going to see higher rates for longer. Although in terms of what I think about all of this, here's my honest opinion. I have to say that we should reduce our expectations for all these recent proposals and tariff threats. Like, let's just start with this one. No taxes for Americans earning under $150,000 a year. On the surface, great idea. I think we could reduce income taxes if we reduced government waste and spending by the exact same amount, except this time, people would have more money left over at their disposal to do with whatever they want. And if this were passed, 93% of Americans would pay nothing to the IRS whatsoever. But realistically, the chance of this actually going through is slim to non-existent, and I thought this post by the Money Cruncher really summed it up perfectly. He clarifies that people making under $150,000 a year contribute $330 billion a year towards income tax, but in order to maintain equality across all income groups, you would have to increase the base deduction to $150,000, or at least have some phase-out range. That way, the first $150,000 anybody earns is tax-free, regardless of if you make $149,000 or $151,000. But now all of a sudden, if you do this, it ends up costing $1 trillion a year, not including the impacts to Social Security or Medicare. Can this be done if we find a way to reduce government spending by $1 trillion? Yeah, theoretically. Can this be done by tariffs? Anything is possible. But the likelihood of this actually going through, as much as I like it, is probably not worth seriously considering. I think the same thing also applies to the $5 million gold card that'll allow anyone to buy US citizenship. And here's what Trump had to say about it.
We're going to call it the gold card. If we sell 1 million, right, 1 million, that's $5 trillion, 5 trillion. If we sell 10 million, which is possible, 10 million highly productive people, that's $50 trillion. That means our debt is totally paid off and we have $15 trillion above that. And now I don't know that we're going to sell that many. Maybe we won't sell many at all, but I think we're going to sell a lot.
Okay, so if you missed that, if we sell 10 million of these, that's $50 trillion in revenue. That would be enough to pay off the entire national debt and then some. Except what he doesn't tell you is that there's only 9 million people in the entire world with a net worth of at least $5 million. And the majority of those people already live within the United States. So in order for this to work, with the numbers that he's quoting, every single person outside the United States who has at least $5 million would have to buy this, which realistically is just not going to happen. Most likely, I think the bare minimum to even consider doing something like this would be a net worth of at least $10 million, which, like I said earlier, most of those people already live within the United States. That's why, from my perspective, someone would probably need about $30 million to consider buying citizenship for $5 million. And when you look at how many people actually have that sort of wealth outside of the United States, it's about 376,000 people. From those numbers, I'd bet that most of those people are probably already happy where they live. But assuming if 10% of those people end up buying it, that's $185 billion worth of revenue to the United States. Yes, that's still a lot of money, but it's not paying off national debt levels. I say all of this just to set the tone that anything that gets proposed is probably going to be watered down through Congress, a lot of things get overpromised, tax breaks are probably going to be a lot more modest than a lot of people expect, and tariff threats are probably just going to be a back and forth negotiation until eventually everything gets resolved. Sure, it's going to be a bumpy ride in the process, but welcome to the entire economy, where there's always something to worry about. That's why I'm just continuing to dollar cost average into the markets on a regular basis, regardless of where it trades. I'd bet we probably see 2 small rate cuts at some point this year, and if you're getting spooked by all the volatility, it's probably best just don't check, stick with the plan as normal, and no matter what, smash the like button and subscribe if you haven't done that already. So thanks so much for watching. I really appreciate it. Also, big thank you again to Cook Unity for sponsoring this video. Their information's down below in the description. Thank you so much for watching, and until next time.